From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views. And today we're continuing our discussion on the impact of sustainability efforts, and in particular around the tax function. We've talked a lot about sustainability incentives, but those are just one side of the efforts to drive sustainability. It's important for tax departments to stay close to their organization's sustainability efforts, especially as it relates to a new group of reporting regimes, which create opportunities for tax to engage with their broader finance initiatives. So joining me today are two Deloitte specialists in the area of tax transparency, Diana McCutcheon and James Gordon. Diana and James, so nice to speak with you both today.
Thank you for having us, Carrie.
And James, I'll start with you. Can you help our audience understand where and how tax plays a role in sustainability?
Of course, Carrie, and thanks for having us today. I think at first glance, often the role of tax and sustainability to the person on the street might not be clear, but on additional reflection, it becomes quite clear actually that the role that tax plays in sustainability is critical, and it's probably one of the more key relationships of all in sustainability. It really is government's key behavioral lever in terms of additional taxes to be paid, but also incentives. You mentioned credits and incentives. I think we are seeing unprecedented credits and incentives being made available through the IRA, but other similar regimes around the world for companies to make investments into sustainability-related issues. Climate transition, renewables, even social-related investments have credits available to them. But alongside, dare we say, the carrots, the credits and incentives, there are sticks which are emerging now too. Additional environmental carbon taxes, things like plastic packaging taxes are emerging for governments to discourage certain types of behaviors or certain types of commercial activities. So as tax professionals, these credits, these incentives, these additional taxes are going to continue to expand around the world. So it's not just here in the US, we're seeing it in Europe, we're seeing it in Asia, we're seeing it in Latin America. And so the role is really critical in these sustainability-related investments and investments more broadly to ensure that the right credits and funding is accessed, but also unnecessary tax liabilities are mitigated. After all, every financial transaction a company enters into has a tax consequence, and behaviors as well have potential tax impacts. And so sustainability is no exception, and tax's role in partnering with the business and identifying these various levers, these carrots, these sticks, is not only important today, but will be more and more important in the years ahead as well. Now, alongside this, tax has always, but increasingly under the lens of sustainability, being seen as a key community good. And so companies are under increasing scrutiny to demonstrate that they have robust governance and compliance processes over tax, but also to be more transparent and to report more about their tax affairs. This includes key decisions and tax risks. It includes their tax policies, but it also includes tax payments, including jurisdictional level information, as well as commercial metrics too. And we'll take a closer look at what some of the standards are out there and how companies can respond shortly as well.
That sounds good. Diana, maybe talk about how, as a company designs and implements its approach to sustainability, why it's important for tax professionals to be a part of that discussion.
Yeah, so Carrie, I think it's really important for tax to be in the room, to be at the table as sustainability initiatives are unfolding and plans are being made within a company. And I think maybe bringing two examples to light might help. In one instance, we had worked with a company that was very keen on working with sustainable vendors and suppliers. They wanted to make sure that those that they were doing business with, those other elements of their supply chain, were following the various sustainability types of requirements and standards that they wanted their own products to have. And so they had this preferred list of vendors and suppliers, if you will. In order to really achieve this goal, they needed to centralize their procurement. They felt like they needed to centralize all of their purchasing and procurement with one company so that they could really make sure that the right vendors and suppliers were being used. Now you've got one company within a global group that's providing a service for the rest of those entities. And doing so, it needs to be compensated on an arm's length basis. And so now we've got transfer pricing, which is a hopefully for tax folks, a very obvious concept. And so you need someone in the room with a tax lens that's thinking, oh, as we start to shift things around with our supply chain, as we start to change the services that companies are providing to other entities within our affiliated group, we really need to make sure that we're doing it appropriately under the transfer pricing regime. And so that's one example. Another is with respect to a company that's really focused on diverse hiring and broadening their talent in the various areas in which they hire. And there are a lot of credits. We think of the IRA credits around climate and environment and so forth, but there are a lot of work-related credits that are available at both the federal and state and local level for hiring, as well as for training and upskilling and so forth. And so having tax involved in those decisions, they can help access some of those funds that could actually help pay for some of these initiatives that the company is going into.
I love those examples, right? They're beyond just green energy investment examples. So thank you for that, Diana. James, talk to us about the tax regulations that are out there that companies should be thinking about, in particular around what they need to disclose from a sustainability perspective.
Yeah, thanks, Carrie. There is a patchwork of regulations emerging around the world. And although regulations are emerging in local jurisdictions, some of them have extraterritorial aspects to them. So you may have to report outside of those jurisdictions as well as within those jurisdictions, merely by having a presence there. Now, tax originally was largely there were voluntary standards, something called GRI 207 emerged about 5 years ago. But what we're seeing is these principles are finding their way in regulations more and more. Now, the most discussed and perhaps some of the more immediate considerations that companies are thinking about right now are public country-by-country reporting regulations, most notably the European Union version, under which companies with significant enough of a presence in Romania may have to report as early as December this year. Australia also has a draft before their parliament that one would expect to come in around 2026 from a reporting deadline standpoint. Under these regulations, companies will have to provide country-level broken down information on commercial metrics, things like tax payments and taxes accrued there, but also revenues, profits, employees, tangible assets. So it's almost a geographical roadmap or footprint of the organization's functions, assets, and risks. Now, under the regulations, they don't have to be broken down under every single jurisdiction, but there is a mismatch between the different regulations. For example, the European Union requires EU jurisdictions to be broken out, as well as a list of what they call their grey list jurisdictions, and then the rest of the world would be aggregated. Australia is a little bit complementary. It would require, under the current draft, low tax jurisdictions. It's a list of about 40 of what one would perceive as lower tax jurisdictions, as well as Australia and the rest of the world. So a lot more transparency coming, country level information through these regulations. And there are different ways to consider and report this. And companies are trying to navigate how they adopt these regulations, whether they comply strictly with the minimal only countries in scope, or whether they provide additional breakdowns, additional narrative, and supporting information to explain their numbers. Now, interestingly, from this year as well in the US, something known as Dodd-Frank 1504 is coming in. It is an SEC reporting requirement where extractive industry companies will be required to furnish a report with the SEC. Now, most of these companies are calendar year ends, and so most of them will be reporting around the end of September this year. And the information that they'll be reporting is more payment focused rather than country by country reporting being more commercial metrics. These are payments to governments. So not all payments to governments but most of them are. And so payments to governments, including taxes, would have to be reported, and that would have to be broken down and analyzed not only by country, but also the subnational jurisdiction underneath. So the equivalent of provinces or states in different countries. So what this means is not only for extractive industry companies, but other companies in other sectors in the US. We're going to see a bit more transparency of tax payments happening here, perhaps for the first time, under a regulation around September this year that may drive even more sustainability reporting in this area for US-based companies. Alongside this, there is an accounting standard update that will take effect in 2026 that will require, again, some level of country-level breakdown for material jurisdictions of tax payments and the rate reconciliation. And so this will require that analysis in the tax note in the 10K. And again, it raises questions around how this ought to be reconciled to other disclosures being made under the public country-by-country reporting regimes, or sustainability disclosures. Indeed, there is a lot of information going out there, specifically at a country level as well, that might not have been reported in the past. And so it could include commercially sensitive data, things like margins, other local level data points that may be of interest to analysts, to investors, and to others, and that could potentially lead readers to draw incorrect or unhelpful conclusions. So a good part of readiness is to consider and look at this data and think how it might be perceived, or what sort of stories or conclusions might be drawn from what you publish, so that you can proactively understand and perhaps put more helpful messaging or data or analysis out there to support the reader. Now, there is a lot of overlap between these regulations and ESG tax reporting standards. As I mentioned, I think there's a link between the two. So the GRI 207 voluntary standard has informed a lot of the regulations. The Australian draft country-by-country reporting explicitly calls it out. So you'll notice that there is overlap between what the regulations are asking for and what some of the voluntary standards have, and that many companies are already adopting. So the takeaway is just to make sure that you join the dots between the data points and even other areas like the country-by-country report you file with the IRS, as well as Pillar 2 data points. There's so much crossover there that it really does make sense while you're looking at your Pillar 2 data readiness to align with public country-by-country reporting and sustainability reporting. It's going to be more efficient, it's going to be more effective, and the data is going to be reconciled out at source, which is a really strong position to be in as you comply with these different regimes. So as I mentioned in summary, a key part is the data readiness here, making sure that your data is complete, it's accurate, it's supportable, it's well controlled. So you've really got to think about the controls here and the reconciliations. But also when you're comfortable that the data is in place and it's supportable, making sure you have the right communication strategy around it, that you've identified those perception risks, and that you're helpfully telling your story and providing complementary information to support the reader and the user of this data.
There's a lot there for tax departments to think about, and especially in terms of connecting with broader finance as they work through those issues that you just described. Diane, talk about how there's all these new climate disclosures, right, that we're seeing around the world. The SEC, California, various European countries have regulations focused on climate disclosures. How does tax come into those disclosures?
Yeah, to be clear, so tax is not explicitly called out as a requirement in these various climate disclosures that you had mentioned. However, its role as both a financial and transition risk is often alluded to. So I think this is going to become more and more important as more and more entities, or more countries adopt carbon taxes, other environmental taxes. 30 countries right now have carbon taxes, but that number is getting larger and larger all the time. So those types of tax liabilities may become even more and more material, and is definitely both a financial and a transition risk, depending on what the company is doing. So as more and more countries adopt these environmental taxes, they could become very material. But then on the flip side, as we'd mentioned, there's credits incentives. And so tax can also help to find some funding for opportunities through credits incentives to support these sustainability initiatives. And so most of these regs have within them kind of an element to financial modeling. And anytime you're doing a financial model, it would be a huge miss to not think of tax as an important data point.
James, take us deeper on one of the regimes we've been hearing a lot about. It's often referred to as CSRD, but it's the European Union's Corporate Sustainability Reporting Directive. How does tax play a role in that specifically?
Yeah, this is a hot topic for a lot of companies around the world. Although it's a European Union directive, it has extraterritorial application, as I mentioned before. Similar to the European Union and Australian public country-by-country reporting, you would have to report on your entire global footprint as an inbound into these jurisdictions, just by having a significant enough presence there. And the CSRD is quite similar. Essentially, it is a framework of sustainability reporting. They are issuing reporting standards that companies adopt around certain issues, climate, for example, but others as well. And initially, you report on your European Union operations if you're an inbound company into Europe and the operations are sizable enough. But later on, in respect of the 2028 year and 2029, inbounds will have to report on their entire global footprint if their presence in the EU is significant enough. And so many companies are getting ready and thinking about CSRD more holistically to be ready for that and to look at their sustainability reporting more broadly. But in strict compliance with CSRD, the first step is really just to scope it and to scope in which entities in your group you'd have to report on first within the European Union. For this, you have to look at the legal entities, you have to look at certain financial attributes to see if it's material or significant enough. And then you determine a scoping exercise in terms of how you're going to respond and what you're going to report on in terms purely from a scope perspective. Now, where tax can help here, they collected a lot of this data in their country-by-country report, in their Pillar 2 data. And so I've seen tax departments really help get involved, providing the information in order to do this scoping analysis. But also in addition to this, tax departments often understand the legal entity structure quite well, the rationale behind specific entities in the group that could trigger a CSRD requirement. And so their perspectives and insights in the scoping, just from a legal entity purpose and structuring perspective, can be really helpful as well in terms of understanding the structure and in terms of the go-forward position too. Now, beyond scoping, companies have to do what they call a double materiality assessment. This is really determining what the key ESG or sustainability topics are to that particular organization upon which they'll have to report. The double materiality assessment looks at the outside in and the inside out impact. So what are the topics in the outside world that will have a material impact on us as an organization, as well as looking what specific topics do we have a material impact as a company on the outside as well. And through these two different lenses, you get a short list of topics that would be deemed to be material. Now, tax's role in this is important, and it should at least be a short list of topics to be considered. Now, whether or not it makes the list of material topics is still an evolving and emerging area, and different companies are coming to different conclusions. But in a recent Deloitte survey, the tax executives who responded, over 80% of them felt that tax was or would be a material topic in the years ahead. So while this is an evolving area, organizations should consider what tax's role might be were a material topic. And a lot of that is really understanding what the reporting might be. Things like GRI 207, some of the regulations that are emerging could come into question in terms of a sustainability report or disclosure on tax. Ways in which tax could be material, obviously companies pay a lot of taxes and have impacts that way, but also the changing tax environment, the emergence of credits and incentives, the emergence of carbon taxes can be financially material from an outside-in perspective as well. So there are definitely different lenses through which to do this exercise. Now, regardless of where an organization gets to with materiality, the role of tax transparency regulations means that companies are going to be disclosing information anyway. As we mentioned, Australia, EU country-by-country reporting, the new ASU, etc. And so it's important as those disclosures go out that you join the dots with your sustainability counterparts in the business, but also the sustainability disclosures and the financial disclosures that are going out at the moment. Now, finally, in CSRD, beyond the materiality assessment, scoping, and all of the areas that might be reported were they to be material topics, there is something called the EU taxonomy regulation, a cornerstone of CSRD that provides a set of common definitions as to what economic activities are considered environmentally sustainable. Tax is actually explicitly in here as one of the minimum safeguards, and it references that companies should seek to comply with the letter and the spirit of the law, and that they should treat tax governance and compliance as important elements of their broader risk management system. So again, as companies are working through CSRD compliance, including the EU taxonomy, reflections should be made on the governance framework and how companies are demonstrably living that framework in practice.
I like that example that you gave, James, about the tax department being the group that's often closest to the legal entity structure and the role that tax can play in helping the rest of the organization meet some of these requirements. I think that's a really great call out for our audience. Diane, talk to us about what a company should do to create a sustainable tax practice.
Yes. So, Carrie, I think first and foremost, the tax team really does need to engage with the business early, often to support the company's broader ESG strategy. What investments are being made? What initiatives are being contemplated? Because as James mentioned at the beginning, every transaction has a tax consequence. So from a positive perspective, the tax team can help the business access funding. They can get the tax incentives, the reliefs, the grants, everything that can help further those sustainability goals. There's a lot out there that the business might not realize without the tax team's help. There may also be some ESG and sustainability initiatives going on and things that maybe aren't as obvious, like M&A, looking at various companies to acquire. A lot more companies are looking at that with an ESG lens, and tax can be a part of that. And I'd mentioned supply and value chain transformations. These are also things that may not scream sustainability, but might have elements where tax should be involved. We talked a lot about corporate income taxes, or at least that's what you might think of first, but we really should be thinking through all of the various taxes. We've got the environmental taxes, but companies are paying a lot of employment taxes, sales and use, VAT taxes. All of those make up their tax profile. And from a reporting perspective, those all get included in some of these tax disclosures. And as we're talking about disclosures, James had mentioned country by country reporting. Rather than just putting the numbers out there, is there more narrative? Is there more story that could accompany such numbers in a sustainability report or some other publication where stakeholders really want to understand and dig a little bit deeper and get the story and the narrative behind those numbers? And finally, a lot of our clients, a lot of companies are really keeping an eye out on what their peers are doing, what their competitors are doing. This is such a dynamic environment. Things are changing constantly. More and more information is getting published. And so really take notice and understand what your peers are doing in this area and what they're putting out there as well. We've got some of our clients, their boards are asking, are we ready to get information out there? Where do we stand on some of this reporting? And so make sure that you understand that environment.
This has been a great discussion about an evolving area where tax needs to get more engaged. James, to wrap us up, what do you see in the future? What does your crystal ball tell us?
I feel the recent past is a good indicator of the future in many ways. I think we have seen a dynamic global environment with respect to credits and incentives, especially here in the US. And I think that's going to continue to evolve around the world. I think we're going to see more credits and incentives, more carrots being made available for companies to access in order to continue to invest in sustainability related areas to help fund the energy transition, to help fund investments in renewables and social and other related investments as well. So I feel that might be the good news as I look into the crystal ball in the years ahead. But alongside that, we are seeing, as I mentioned, the emergence of environmental taxes. And I think these will continue to expand. These are things to monitor at a local level. Plastic packaging taxes, for example, in the UK, in Italy, and other jurisdictions, I think are going to become more common. Chemical excise taxes, carbon taxes, I think will become more important, but also regimes similar to the carbon border adjustment mechanism in the EU, which is an interesting area in terms of applying some kind of tariff to reflect carbon emissions outside of the EU that went into manufacturing a good that was imported into the EU. So again, extraterritorial areas of law that different jurisdictions are incorporating. So these types of levies, these types of tariffs may have a significant impact on supply chains and operating models going forward. In other words, I think there's going to continue to be innovations and interesting taxes and levies emerging that we as tax professionals will need to monitor and adapt to and support our businesses in transitioning in the years ahead. Now, Diana also mentioned sustainability disclosures in terms of climate disclosures and taxes' potential role. I do think as carbon taxes continue to emerge, it's likely that tax will find a home in those disclosures much more routinely than it does today. And so, as Diana pointed out, I reaffirm it's worth thinking about what that might look like in the not too distant future as that area continues to evolve, as well as the tax dedicated disclosures. I think we're seeing regulations come onto the books and now come into force in the next few years. So I think tax dedicated disclosures, country level information, they're going to become much more commonplace. Increased transparency of payments, increased transparency of commercial data, but as well information on risks, on governance and company stories. And so I think keeping an eye, as Diana pointed out, on the market and how others are telling their stories is going to be really important in the years ahead as companies start to put more information out there.
Well, I guess as always, there's more to come on this topic. Well, thank you, Diana and James, for sharing that information. Thank you, audience, for listening. If the audience would like more information, you can go to Deloitte.com and search on sustainability, which will take you to our sustainability, climate, and equity site, which has a broad range of information on this topic. You could also connect with James and Diana on LinkedIn. I hope our audience joins us again the next time, and everyone, please live well.